Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and short squeeze dynamics. Today, we're dissecting a very specific name that recently hit our screener with some truly eye-popping borrow fees. BIYA International Group Inc., trading under the ticker BIYA. This isn't just a generic overview, we're getting granular with BIYA's unique situation. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, let's talk about BIYA International Group Inc. Joe logo/ticker. This company operates in the technology/software application sector, but specifically, it provides crucial human resource services in China. Think job matching, entrusted recruitment, project outsourcing, and labor dispatching. Essentially, they help businesses find talent and manage their workforce. With a market capitalization of $76.06 million, BIYA is firmly in the micro-cap territory, which often brings its own set of unique market behaviors. What is cost to borrow and why to mouse? Before we get further into BIYA specifics, let's quickly explain cost to borrow for any beginners watching. When you short a stock, you're borrowing shares from a broker to sell them, hoping to buy them back later at a lower price and profit from the difference. But borrowing isn't free. Brokers charge a fee called the cost to borrow, or CTB. This fee is annualized, and it can be astonishingly high. It's essentially the supply and demand for those borrowable shares. If many people want to short a stock and few shares are available to lend, that fee skyrockets. It can even exceed 100% annually, meaning you'd pay more than the share price itself just to hold your short position for a year. Why this stock is hard to borrow right now? Now this is where BIYA gets interesting. Our screener flagged BIYA International Group Inc. because its cost to borrow fee is currently an astounding 823.2% annualized. Zoom in on CTB number. Let that sink in for a moment. This tells us there is extremely high demand to short BIYA shares, and very limited supply of those shares to lend out. With an estimated float of just 2.7 million shares, any significant short interest can quickly make borrowable shares scarce. While the exact number of shares currently available to borrow is unknown at this very moment, a CTB of over 800% is a screaming signal that finding shares of BIYA to short is a serious challenge, and short sellers are paying dearly to maintain their positions. Squeeze mechanics explained. So, why does a high cost to borrow matter? It's a key ingredient in the recipe for a short squeeze. Imagine short sellers are paying 823.2% annually just to bet against BIYA. If the stock price starts to move up, perhaps on positive news or increased buying volume, these short sellers face a double whammy. Their positions are losing money, and they're paying exorbitant fees to hold those losing positions. Short squeeze chart concept. At a certain point, the pain becomes too great, and some short sellers will start buying back shares to cover their positions. This buying creates more upward pressure on the stock price, which then forces even more short sellers to cover, creating a cascading effect. That's the short squeeze. However, it's crucial to understand that a high CTB does not guarantee a squeeze. It can also simply indicate that short sellers have incredibly strong conviction that the stock price will fall further, and they are willing to pay a premium for that bet. Dilution risk check. One critical factor that can neutralize even the highest cost to borrow is dilution. New share issuance can flood the market, giving short sellers an easy way to cover or creating downward pressure that outweighs any squeeze potential. For BIYA, our check found no recent diluted SEC filings like -1s, -3s, or 424 BS in the last 90 days. This means, at least for now, there isn't an obvious near-term risk of the company directly issuing new shares and diluting existing shareholders, which is a positive sign for any potential squeeze thesis. Recent reverse split watch. Another very important factor for BIYA is its recent corporate action. BIYA International Group Inc. executed a reverse stock split, a 1-4-10 split, just 10 days ago on July 13, 2026. Highlight date. A reverse split reduces the total number of outstanding shares and, consequently, the float, while proportionally increasing the share price. For microcap stocks like BIYA, historical patterns have shown that many tend to experience renewed volatility or even a price pop within about a month after a reverse split. This isn't a guarantee for BIYA, of course, but it's an observed tendency in some small cap names as the market digests the new share structure and resets investor interest. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, with an 823.2% CTB, an estimated 2.7 million share float, and a recent reverse split, what should we watch for with BIYA? Currently, the market seems to be favoring the bears. BIYA International Group Inc. is down 10.37% today. It's fallen 35.27% over the last 5 days, and a staggering 77.85% in the last 30 days. Volume has also been low, with today's volume at 1.3 million shares, significantly below its 30-day average of 5.8 million, giving it a relative volume of only 0.2x. This indicates that while the borrower fee is astronomical, the current price action and low volume suggest shorts are still firmly in control, and there hasn't been a strong influx of buying to challenge them yet. Our internal composite squeeze score for BIYA sits at 52.0 out of 100, indicating moderate, but not extreme, squeeze potential when combining all factors. To see a change in dynamic, we'd need to observe a sustained increase in buying volume for BIYA, potentially coupled with a positive catalyst or a significant shift in market sentiment to truly put pressure on those high-cost short positions. BIYA International Group Inc., or BIYA, presents a fascinating case study with its astronomical 823.2% cost to borrow and recent reverse split. While the current price action suggests short sellers are winning the battle, the extreme cost they are paying to maintain their positions, combined with the low float and post-reverse split volatility pattern, certainly makes BIYA stock worth watching closely for unusual activity. Remember, understanding these mechanics is key to navigating the markets. If you found this deep dive into BIYA valuable, please hit that like button, subscribe for more unique analysis on hard-to-borrow stocks, and let us know in the comments what other tickers you'd like us to cover. We love hearing from you.